Okay, this should be a fun video. I'm going to be going over my worst investments as a dividend investor publicly on the internet. So the plan here is to identify my worst performing assets, see what's going on, check in on the companies, check their finances, look into some articles, see what the analysts are saying, and then I want to give my updated opinion on it. Am I thinking about selling it? Do I want to buy more? So, just what's my current stance on the company? And before I get into that, I do want to say how I view dividend assets because I have both dividend and growth assets in my portfolio. And when it comes to both kinds of assets, the major things are the growth in the revenue, the market share, how innovative are they as a company, what problem are they solving, the basics of a company. With the growth assets, the growth in the market share, the revenue is the most important thing, and it usually dwarfs the growth of larger established dividend companies. However, dividend assets have a component that growth assets don't. When I look at all my dividend companies, I view each one of these as a compounding machine. After all, that's the whole point of dividend growth investing. The average growth rate in the dividend of my portfolio as a whole is around 8%, and this portfolio is over 1 year old. So that means right now, my portfolio is generating 8% more income than it did last year if I didn't even add any additional capital to it. And that's the magic of dividend growth investing. And each one of these holdings is a compounding machine. So when I look and evaluate these companies, along with the growth in the revenue, the market share, what they're doing in the market to provide value, the compounding effect of a growing dividend is a priority to me when it comes to this side of my portfolio. Okay, but enough of that. Let's get into the pain and suffering. So we can filter by return. These are actually my best performing assets, but we can click it one more time, and these are my laggers. Divo is a new holding. It's also an ETF, so I'm going to be avoiding that in this video. I just talked about it in my last video, so if you guys want to get some insight on that, you can check it out on the channel. But here are my top 5 losers: Visa, Broadcom, Store Capital, Lockheed Martin, and Merck Co. And I want to reiterate that this data is just for 2021, so almost the past 9 months. And the first thing we're going to notice is that all of them, even my worst performing asset, is in the green. So I'm just going to go ahead and pat myself on the back for that one. Good job, Nick. Although in fairness, some of these holdings throughout the past few months have been going back and forth between the red and the green, but right now they happen to be in the green. So let's begin with the 5th one on the list, Visa. So this should be pretty quick. Visa is a company we all know and use their product. I'm sure in your wallet right now you have a Visa product for payment processing. And the story with Visa is the story of the economy. As the economy grows over time, Visa as a payment processor is going to grow pretty much in step with the economy. So in my portfolio, I kind of view it as a stabilizing force in a way. And the big concern with Visa right now and MasterCard, they kind of have a duopoly, is that the revenues dipped a little bit in 2020 because of something called a global pandemic. Long term, though, when it comes to my investment in this company, I'm not concerned at all. As mentioned, it follows the economy, and the economy over the next 5-10 years is most likely going to get a lot larger. And Visa is going to continue to grow along with that. And in terms of innovation and cryptocurrencies and all that kind of stuff, I see them making the proper moves, the proper investments, and I don't get the sense that they're falling behind in any means. So to me, there's no red flags in this company. But of course, the dividend is the major thing, being that it's on the dividend side of my portfolio. And Visa does have, I think, the lowest dividend yield in my portfolio, at least of the assets that provide a dividend yield. It's only 0.55% right now, but the benefit is that the payout ratio is only 22% and has a very fast dividend growth rate. This is the compounding nature of the holdings, and Visa is super high. In fact, if we come over to the dividend yield tab, we can see the yield on cost over time. So the way you read this graph is if you just bought Visa today, you are right here. So your yield on cost is the current yield, which is 0.55%. If you hold it for 3 years, you would now have a yield on cost of 0.91%. And if you held it for 5 years, you would now have a yield on cost of 1.59% with Visa. So this does a good job illustrating the compounding engine of dividend growth. Unfortunately, like I said, Visa has a small dividend yield, 0.5%, so I'm not super enthusiastic about Visa. It's a blue chip name, and I am glad to have it in my portfolio. So moving on, the next worst performing asset I have is Broadcom, surprisingly. So Broadcom is definitely a lesser known of company than Visa. So I want to begin this one by reading a few highlighted bits from this article. I'll leave it linked down below. But it's titled 3 Reasons Why Broadcom Will Remain a Great Dividend Growth Tech Stock. This is referencing the growth path of Broadcom, and it says the company is well positioned as their 23 category leading semiconductor and infrastructure software divisions are well supported by $5 billion in research and development spending in 2020 alone. And not to mention they have over 20,000 patents. This gives them one of the broadest and strongest intellectual property portfolios in the industry and positions them well to sustain their competitiveness. The company has proven itself adept in reinvesting its massive free cash flows into mergers and acquisitions. So essentially, this company is heavily reinvesting back into itself and has a ton of intellectual property, and it's spending its money very wisely for continued growth. If I continue, it says, last but not least, we expect Broadcom to continue shining as a dividend growth machine for years to come due to their strong competitive positioning, bolstered by continued aggressive R&D investments, their existing intellectual property portfolio, and strategic mergers and acquisitions. Their businesses are well positioned to continue capturing growth in their markets. Yeah, so Broadcom is a beast of a tech dividend stock. The only reason why it's a lagger in my portfolio right now is because that data was reset in the beginning of 2020. And for most of 2020, it has been just consolidating, moving sideways. And if we zoom out a little bit, we see why. It had an immense 2020. So a consolidation period after a move like this is extremely common. Here's a look at their total revenues. It is a thing of beauty. If we take a look at their historical dividend yield, we can see that even though the company's stock price has been skyrocketing, the yield, it has been coming down, but it hasn't been coming down that aggressively, and that's because of their insane dividend growth. And that can be illustrated by their yield on cost. So again, right now the yield is roughly 3%, but if you've been holding it for just 3 years, you now have a yield of almost 7%. I mean, just take a look at their CAGR over the past few years. It is touching 50%. So this is one of my favorite compounding machines. All right, moving on. The next one in my portfolio is Store Capital, and this is a REIT. Think of it a lot like Realty Income, but a smaller version of it. And instead of focusing on big brand names like 7-Eleven, Home Depot as a triple net lease provider, Store Capital focuses on what they call middle market. Who are the tenants of Store Capital? Store Capital's tenants generally fall into 3 buckets: service companies, fitness centers, restaurants, education, retail, big box, grocery stores, and manufacturing. They have a 99.6% occupancy rate, 529 different customers, and 2,738 investment properties. We're looking at the year-over-year growth in their total revenues, and it's around 20%, although in 2020 it did take a dive and it only grew by 5.75%, which is understandable and at least it's not negative. But I want to compare these numbers versus Realty Income, because Realty Income has a year-over-year growth rate that's only around 10%, still great, and because of their larger size, they did fare better in 2020. I mean, I also do hold Realty Income, but I like having both because this one offers slightly more growth. And lastly, we can take a look at their dividend, and this is another thing I like about this REIT. It's high. It's over 4% with a decent dividend growth rate. Taking a look at their stock price, it has gone up 43% this year, and if we zoom out a little bit to the 5-year range, it has almost completely recovered from its pre-pandemic levels, although it still has some room to go. So Store Capital is a great REIT, but I'm not super excited about it. It does have potential to grow faster than Realty Income. Realty Income is more stable though, so that's kind of the trade-off between the two. Now, one company I am super enthusiastic about is the next one. This is Lockheed Martin. And I'm not the only one bullish on Lockheed Martin. This website gives it a 7 out of 10, and the consensus is a moderate buy, and blogger opinion is quite bullish, although the news sentiment and the momentum behind it right now, as we can see by this metric right here, is lacking, giving it potentially a good buying opportunity, and it's why it's one of my underperforming assets in my portfolio right now. In fact, to paint a better picture of what's going on with Lockheed Martin, let's read some of this article. So Lockheed Martin missed Q2 2021 earnings due to a change in the aeronautics segment, and the sales outlook was also lowered. So again, that's why the news sentiment and the current momentum has evaporated from Lockheed Martin. Although the company raised the total earnings guidance for 2021. Lockheed Martin is acquiring Aerojet Rocketdyne to establish leadership in the missiles and hypersonic propulsion. The dividend is well covered by earnings, and the yield is greater than the trailing 5-year average. The stock is undervalued. Here's a bit of an overview on the company. So Lockheed Martin Corporation, which was founded in 1912, is today the world's largest defense company. The company consists of 4 business segments. Aeronautics, which is the largest at 40% of sales, which produces military aircraft. Rotary and missile systems, which houses combat ships, naval electronics, and helicopters. Missiles and fire control, which creates missile defense systems. And lastly, space systems, which currently is only 17% of sales, which produces satellites. But I think this whole space system, and if I come back up here to the acquisition of Aerojet Rocketdyne, is going to be a larger role in this company in the future as space exploration and business opportunities continue to expand. So as we gathered from that article, the past 12 months have been rocky for Lockheed Martin, and if we zoom out to 5 years to get a better view, we can see this pullback is semi-significant, but it does give a great buying opportunity because the fundamentals of the company are very strong. Looking at their total revenues, we can see pretty consistent growth, and the article did mention that they did raise their overall guidance for the year 2021. So the company is having no problems generating revenue, and because of that, they are a dividend growth compounding machine. The current dividend yield is almost 3%. And side note, whenever I see Lockheed Martin with a dividend yield approaching 3% or above 3%, it is almost always right now a great buying opportunity. And it's getting close to that range. The payout ratio is less than 40%, and they have very fast dividend growth. Here's the historical dividend yield, and as mentioned, right now it is approaching a very high level. Back here is actually when I bought some more shares when it was touching a 3% starting dividend yield. But this shows the power of the dividend growth of Lockheed Martin. So right now the yield is roughly 3%, and if you've been holding it for 5 years, you're looking at a dividend yield over 4%. All right, so that leaves us with my number one loser of a company, which is Merck Co. This is a large pharmaceutical company, and it's essentially been flat the whole time I've been holding it. Merck is another one of those companies that's a little bit hard to understand what they do exactly, so I have an article to give us some background knowledge. And you're going to notice a trend here. Just like with Broadcom, the tech dividend super company, Merck Co is also very financially prudent, and they aggressively reinvest back into their business to continue to expand their moat. And that's the title of this article. It says Merck Co, a wide moat business at a discounted price. Some highlights here. It says the moat is rooted in technological lead, scale, intellectual property, and strong pipeline. As a result, the business enjoys high profitability, return on capital employed, and healthy perpetual growth prospects, the hallmarks of a long-term compounder. And again, that compounding nature of my dividend holdings is one of my top priorities, and this company has that. I thought this was kind of interesting. So this is a pharmaceutical company, and it says it caters to a fundamental human needs that is not going to change or go away anytime soon. All signs show that the need will only intensify with population growth, longer life expectancy, and more interconnected world. The major players like Merck Co, due to their established lead and scale, are especially well positioned to capitalize on such secular trend. Its operations are comprised of 2 segments, pharmaceutical, which are the vast majority, and animal health. This gives some great background on what's important for companies like this. So, for pharmaceutical companies at this scale, sustained success is all about maintaining a healthy pipeline of potential blockbusters. And Merck has been doing a terrific job on this front, as you can see from their following chart. Merck has been maintaining a promising pipeline in several key areas: oncology, cardiovascular, neuroscience, and animal health. Moreover, Merck has actively supplemented its pipeline and portfolio with strategic business development and partnerships. This is reminding me a lot of Broadcom with their strategic mergers and acquisitions. Over the next 5 to 10 years, its rich pipeline is expected to address areas of high unmet need to drive performance. And here are some charts that this article is referencing. And this one is my favorite: the commitment to the dividend. They have been not only growing their dividend, but increasing the growth rate in their dividend in the past few years. So the total revenues of Merck Co have been slowly increasing. This isn't a hyper growth company like PayPal or anything like that. It's very established, but they're making the proper investments and it's starting to be reflected in their revenues. But especially over the next decade, those investments should be paying off more and more. We can take a look at their historical dividend yield to see if it's a good time to buy this company, because there is that inverse relationship between stock price and dividend yield. If the stock price comes down, the dividend yield tends to go up. And if the fundamentals of the company are good, that could be a great mismatch and a good time to buy into the company. In fact, if we come over and look at the top 10 holdings of SCHD, one of the most popular dividend ETFs out there, Merck Co is one of their favorite bets right here up top in number 4 position, along with Broadcom. Broadcom is right here too in the top 10. So if you don't trust my research and opinion on these companies, maybe you trust SCHD. And those are my top 5 worst performing dividend stocks in my portfolio. And as you saw, I'm pretty bullish on all of them. The one that I'm not super bullish on is Visa and Store Capital. I still think they're both great companies. As I mentioned, Store Capital is just kind of boring. There's not much going on with it, which is usually good for a REIT, and I'm enjoying a nice high 4% dividend yield as I just hold on to it. And Visa, it has a low dividend, but it is growing fast, and it does kind of follow the general economy, and I think the economy is going to grow over time, so Visa should grow over time along with it. And companies like Broadcom, Lockheed Martin, and Merck Co, I think are excellent compounding machines due to their high dividend and high dividend growth rate, along with their strong and dominant market positions that continue to have a severe moat because of their aggressive reinvestment into their business. So that's going to do it for this video. If you guys are still watching and enjoyed, definitely give the video a like, subscribe to the channel, all that YouTube stuff, and I'll see you in the next one.